Good afternoon, Mr. Brian Schmidt. Thank you very much for doing this. I really appreciate your time.
Good afternoon, and thanks for having me. I'm very excited about this.
For the listener, you are the CEO of Tamarack Valley Energy, but to get it from the source, what is Tamarack Valley Energy?
So Tamarack Valley Energy is a company that's focused on two key plays. We're a conventional company and focused in the Clearwater and the Charlie Lake. About 68,000 barrels a day, about 85% liquids. We're in a very exciting time in our company right now.
You got rid of your legacy Viking assets and whatnot to carve energy, if I'm correct. So you've been busy.
Yeah, I've been busy. That's kind of culminates a strategy that we put together through COVID period. We ended up with a pretty good balance sheet coming out of COVID because we hedged quite heavily. And we had some good oil coming on in the Viking that helped us on our balance sheet. So coming out of COVID, we had a very good balance sheet and we're in a very good position, and a lot of companies weren't.
Mm-hmm.
So we were able to think about our strategy going forward, and we came to the conclusion that moving out of the plays we were in and moving into other plays was a good time to do that with given the conditions.
And I have to ask, where's Tamarack Valley? I have been wondering that for years. So maybe, again, to get it from the source, why did you name it the company after that place?
You mean how did we name Tamarack Valley? And
yeah,
you think coming up with an oil company name is a simple process, but it really isn't. Like, you start thinking of names and then you want to put some context to what it means. But tamarack trees, of course, everyone's familiar with tamarack trees. They're large trees.
Mm-hmm.
And they are known for being strong, durable, and flexible. And interestingly enough, before they had survey stakes that were made of steel, they used tamarack trees because they would last, because they were the most durable thing in Western Canada that you could find for that purpose. So, yeah, fits perfect.
Makes sense.
And I love the valley. I like that name because I'm in Turner Valley, and so.
Yeah.
Yeah, hence the name. But it was kind of neat to think about that.
There isn't a specific Tamarack Valley that you're thinking of?
No, there is not.
I've always wondered.
No, not a place. Yeah.
Okay. And so to go back in time, how did you get into the energy industry and why?
Yeah. So I grew up a rancher, a ranching family in southern Alberta near Waterton Lakes. Of course, there was some oil and gas activity in that area at the time, and so agriculture and oil and gas was kind of quite familiar. Couldn't make much money in ranching, so I thought I would go get an engineering degree. Someone asked me about the origins in your family before. My father, being a rancher, he still had some work to do with BA, actually picking out the original plant site in Pinch Creek, and took the CEO out on the saddle horse and picked that location. And it's interesting, you go back to my grandfather. I was talking with someone about this yesterday. The original well in Western Canada was in Cameron, up Cameron Lakes. And my grandfather used to haul barrels of grease out of there with a horse and wagon out of there. There was no market for oil, really. You just burned the light ends off and made axle grease and put it in barrels, and out you go. So that was about 1914, something like that. So listen, there's lots of people in Alberta have a background in both, and I think it's kind of neat to reflect on that.
So were your grandparents homesteaders?
They were homesteaders, yeah, from
Really?
Germany, yeah.
That's rare.
Yeah, a lot of Germans moved from Germany to Nebraska, and then when Alberta was giving away a quarter section for you to homestead, a bunch of Germans moved up into the Pinch Creek area, Waterton area, and my grandfather was one of them.
And stayed,
yeah.
And you grew up in Waterton?
Grew up near Waterton, yeah.
Wow.
Yeah.
And did a mechanical engineering degree at UC, I think.
Yes, I did. And the Shell Waterton plant was there, and I worked the summers at Shell and did my bit, loading sulfur and the jobs down. Spent my time in those kinds of jobs in the summer, and then when I graduated, became very interested in the oil and gas industry there. When I graduated from university, I got a job down in Waterton as an engineer, and then moved around with Shell over my career.
Right. So was your plan always to work in energy?
Yeah, it was. And I thought, well, I'll buy a ranch one day with maybe afford that. And so
Okay.
I did buy a ranch. I have a ranch in Turner Valley, so it worked out the way I planned. I got a little bit of both, and I quite enjoy that.
So your first job was at Shell.
First job at Shell, and I worked at 18 years at Shell in some field locations and the office. Shell at the time they were a dynamo. They just had so much going on, and they were trying some really interesting things. That was the advent of steam in up in the Peace River area. They had Mackenzie that Delta that was being looked at. There was some gas reserves they had in Mackenzie Valley. I got involved in the Bearberry sulfur plant. That was a 98% H2S development on a pilot project, and technically that's very challenging. And then the EOR projects and the oil fields got involved in that, ethane floods, carbon floods in Mydale, Weyburn, that sort of thing. So it seemed like that there was some kind of technical twist. I got thrown at.
You were there for almost 20 years. Was your plan to stay at Shell indefinitely?
It was. I got to a point where I was running the Plains business unit, and at the time Shell was getting out of the Plains, and so we put it up for sale, and then the acquirer Apache approached me about a job. I had a job offer in the North Sea that with Shell I could go over, but I kind of got worried about what would Shell look like when I got back, and so I decided to take the job with Apache.
Right.
And it was a great move. Just I learned a lot at Apache because you just end up doing a lot. Mm-hmm. Our capital budget was 1.4, 1.6 billion per year, and it was busy. We were, I think at the time, the second most active driller in the basin. So when you do a lot, you learn a lot, and so those were good years at Apache.
So you ended up as president of Apache. What year did you go over there? I think you would have spent 80s and 90s.
Yeah, I went over there in 1999, and I left there in 2007. And the last 3 years were president of Apache Canada.
And so at that point, did you think to yourself that you had a executive level position ahead of you at Apache?
Yeah, so that became pretty interesting because I was told when I was going into that president position, they'll probably ask you to go overseas. Eventually, that's what happened, and so there was someone coming into my job, and so I had to go overseas or leave, and I decided to leave because I wanted to start something on my own. I wanted to go from very big and to something pretty small. So I left and decided to try this.
Right.
And give it a go.
That was what led into Tamarck. But at Apache, was your thoughts that you'll just be executive here for a long time because you had success? You grew it from, I think it was about 14,000 BOE a day to 100,000 BOE a day.
Yeah.
So things were going pretty well.
Things are going pretty well. But the Apache is an American company, and they rotated their leadership all the time. And so I was on that.
I see.
That daisy chain, and then it becomes a question of, are you going to come back to Canada or not? And so my kids were involved in stuff here, and I thought, you know what, I'm gonna stay here, and I wanted to try something myself.
Which led to your entrepreneurial ventures. So what year was the year you left Apache then?
So I left in 2007, started a small private with private equity, sold that within a year, and then started Tamarack Valley, public entity.
So that was Spearpoint Energy, I think.
That's right, yeah.
So for the listener, what was Spearpoint Energy?
Spearpoint Energy was it was a company focused on larger farm-ins, and so we had some farm-ins with the majors that we had organized, but just getting off. 2008 happened, and then private equity player said, let's put it up for sale because, it was tough to find fun things at that. So I put it up for sale and sold that company, and then kicked over and started Tamarck.
So you had the first entrepreneurial venture for about a year and you sold it.
Exactly.
So you're happy.
Yeah.
Things are going well.
Yeah. Well, it was in my view premature, but they're the shareholder. So we turned it for a profit and did okay with it. But I think had we run it out with some of those farm-ins, they would have actually, I know how they turned out later, and they turned out really well.
So what assets were you drilling back then?
I had one agreement with the Montney play, and I had another one with BP on Cardium type assets. Yeah. In West 5. Yeah.
So you sold it, and then you roughly started Tamarack?
Sold it. It's pretty interesting because I was remember we had to get going and get Tamarack going because we wanted to go to land sale. So I was in one room of the law firm signing off the papers to sell Spear Point, and I was in the next, and my CFO was in the next room getting papers to start up Tamarack. So it was that's there's a few things in your career you remember, but that was pretty funny actually, closing one down, starting one up in the same law office the same day, and getting subscription agreements in for Tamarack. So
it was busy but good times.
yeah, it was good to get going with Tamarack and get that going.
I read that Tamarack originally was called Tango Energy. What was Tango?
Yeah, so we started Tamarack private first, friends and family money. We wanted to focus on the Cardium, and the acreage was available in Lochend, and the land sale was coming up. That's why we had to scramble for that. Interesting enough, when that land sale came up, I didn't have enough. I knew subscription agreements were coming in, but we didn't have enough to go with the land sale. So I went to my wife and said, how about we take a lien on the house and go to that land sale? So imagine that, going to your wife and talking about that. And she said, well, I'll trust you with it. And I was pretty sure the subscription agreements were going to come in. And I asked my CFO, I know my guys are good for it. Are your guys good for it? And he says, yeah, they're good for it. So we took the risk, got the land, and that's where we ended up drilling our first well. But I actually felt that it's a risky venture to buy land and drill a well. You don't know, that could have been the end of the company, or could have been a real success. So I did a reverse takeover of Tango Energy. Then I became public with that mechanism. And if I drilled a dry hole or a failure, I had enough revenue from what they had in their operation to survive.
Right.
And that's the way we managed the risk through that piece. First Waterflood are great. So, it was a good play for us and a good kickstart.
So you start Tamarack, had to take over another company to get some production and some security, and you raised the money, and you were, what year was this again?
That was be about 2010 was when the RTO was, June 2010. And we operated about a year before that as a private.
And how much production did you have?
700 BOE a day of gas.
Okay.
And then we put on a well that started off, I think it was about 700 or 800 barrels a day of oil. Our first well in Lochend.
First well.
Yeah.
That's good.
It was good. Yeah, that was good. We actually had a wreck on the drilling. Like I was OE'd on the drilling because we got some tools stuck, but you know what? The volume, thank goodness the volume made up for it. But I would say that managing risk is probably one of the key learnings. We're pretty good at the science of what we do and trying to figure out how to do some pretty technical things. But risk management, both technically and financially, is real key to the success of any company, but particularly a startup when your own money's in it too. Yeah.
So you could say you had skin in the game at that time.
Oh yeah, way too much. I don't know. I don't know if I get asked the question, would you do that again?
Mm-hmm.
Probably I'd do it a little different. Yeah. But, we made it through. Yeah.
That was 2010. And what was the value proposition for Tamarack at the time? Were you planning to flip the company and make some good money?
Everything, that was at a time when I'd say we were just getting out of the era where it was, get your production up to, 2,000-3,000 barrels a day and sell. Mm-hmm. And yeah, that was the original intent, that I was going to do something small and
try and sell it.
Not get that big. And, getting where we are today, it's largely because those avenues closed up. And so it's quite different today, for sure.
Yep. That was 15 years ago.
Mm-hmm.
Time has gone. It has lasted, like the name would suggest.
Yeah.
But at the time, was it hard to get money? Was there anyone helping you with your first equity raises?
You could raise money. I mean, think about it. I had a really good well. Mm-hmm. I had enough sections, enough inventory now for us to go. And in those days, getting equity was pretty easy. Mm-hmm. There was always, you read in the news all the time that there was someone raising money, $100 million here or this or that. And it just, that was quite easy to raise money. The challenge is, how do you make it on a per share basis?
Actually make money.
And actually deliver. And you have to realize that there's competition that are raising money that don't have necessarily economic discipline like that, and you're trying to get assets. So that became pretty hard to get high quality assets and not overpay.
Right.
And I'm kind of a rate of return guy. If I can't get a return, I just put my number in, and if you don't get it, you don't get it. Sounds good until you can't grow, because there was a lot of money at the time that was around, and the returns in that era were quite poor for the industry.
Right. So how did you get your assets then? You had some money and you were looking around, and then
Well, you end up
from there?
taking a bit more risk, a bit more organic growth, and that worked out okay. I think what we got known for is execution and, delivering wells and grinding down cost and rolling up your sleeves, and that kind of counteracted some of the it helped on that return of capital framework.
At the time, it was Viking and Cardium wells you were drilling?
Yeah, so we got into the Cardium first, and then the two key assets we added on were the Wilson Creek, Rimbey, in the Rimbey area, and then eventually we bought the Viking assets in Consort.
And this was circa 2012 all the way up?
Exactly, all the way up, yeah.
COVID. And
adding on, and so we became a Cardium Viking company up to COVID.
So that was the plan, and you were going along fine, and eventually, we'll get into, you got into Clearwater, Charlie Lake, but before that, you navigated through 2015, 2016 when things got rough. Was that a tough period for the company?
Yeah, it was tough because when you think about a conventional play or an unconventional play, you're facing decline rates, in that 38% corporate decline, and you're drilling wells. So you're always on the hunt for inventory, and so sustained capital is fairly high, and so you really had to watch debt levels. And at that time, the industry was taking on more debt than they were now. It wasn't unusual to be 3.5 times debt to cash flow, and now you get penalized if you over 1.
Yep.
So, and there's good reason for that, which I could go into, but it really meant that if you had that drop in price, it's with that high sustaining capital, and it was going to be very, very difficult. So the timing of a downturn relative to your balance sheet, it's a key factor. And coming into COVID, we had a good balance sheet. I had just put some hedges in January that locked up 60% of our production at something like $60 a barrel. And I remember those hedges. At one time, we got offered by somebody to buy those hedges for $90 million because oil was like $10, right? But interesting enough, the banks wouldn't let me sell it. So I think, but we did, as I mentioned earlier, we did come up in a position of strength. And the investor turnover and what investors wanted had changed substantially. And it's a quite different business now. If I look at the businesses now, oil businesses now, they're good, long, sustaining, solid businesses. We didn't have the quality of companies back in 2015 that we do now. There's a lot of good companies now. The ones that survived for a reason. And I think now we're looking at strategically, we said, let's look long-term. The investors are going to compare us to other sectors. Yeah. And before they look 2 or 3 years out. And we felt if we focused on, things like debt adjusted free cash flow per share as a key metric, that would be real, an advantage. And when you put Clearwater and Charlie Lake into that model, an 8-year model, those two assets performed very well.
Yep.
So we decided to make the change.
So you came out of 2016, 2017, pretty rough time in the industry, and you're focusing on the Cardium / Viking, I think, and you're going along pretty well. What were you thinking in those few years before the pandemic and in that little time frame before things got really hard in 2020?
This is hard. We were 20,000 barrels a day.
Yeah, like 2019.
I was drilling, I think, probably close to 200 wells a year.
Right.
And I was scrambling to add inventory to back that up. I was doing okay, not great, but okay.
Yep.
Now I'm, almost 70,000 barrels a day, and I'm drilling like 95 Clearwater wells and maybe 20 Charlie Lake wells. That's it. the business has changed, I think strategically for the company. That was a great move to get into those plays.
Right. So then you got to 2019 and then the pandemic hit and things got pretty tough.
Pretty tough. Yeah.
March 2020, I think Tamarack share price fell to a low of about 40 cents.
Yeah.
So
Yeah.
what were you thinking at that time? What was the...
Well, my CFO was pretty happy about that because he joined the company and he bought a bunch of stock. So he's doing pretty good. But it's everybody, there's a lot of companies that lost almost all their equity through there.
Yeah.
And I think the ones that had higher debt were in serious trouble. It really didn't take very long for them to get in serious trouble.
Yep.
And so, I hear the joke about banks, it's like giving an umbrella, but you can use it except for when it rains.
Right.
It is so, companies felt that the banks had to put pressure on and they did. And that forced assets to be freed.
Right.
And some companies didn't make it through.
But what were you thinking? You just got to get through this.
Well, for us, I mean, we were in reasonable shape coming out because of those hedges and the bank debt. I had just missed out on a large acquisition before COVID, which was great. We didn't get it because it probably would have sunk the company.
Right.
But my balance sheet was in pretty good shape. So coming out, when we decided to switch into Clearwater and Charlie Lake, there was assets come free for us that were good, high quality assets. Some of them big land base, and they just turned out great because they were in the Clearwater. So, the cost to benefit there was quite attractive.
So you made it through the pandemic, 21, and you spotted the Clearwater.
Mm-hmm.
And so, do you remember when you first learned about the Clearwater formation, and what were you thinking at that point? You got to get involved.
Yeah, it's I had a board director on in my board, and he was pursuing that, and I kind of stayed away from it for that reason a bit, to be honest with you. But I learned a little bit about it, and it just when we put it in a model and we were doing this strategic change, it was quite evident that was a play to be in, and it's a very large play. So we decided to pick some areas and work that. So it was exciting.
And maybe for the listener, what is the Clearwater play?
So the Clearwater play, it's really interesting because we've known oil's been there a long time. Thousands of penetrations through there. And it was thought to be not movable unless you used steam or some kind of solvent. Mm-hmm. But lo and behold, one of my competitors found a well where there was a DST. And they definitely got oil out of that DST. And so it became evident that the oil was not as thick in certain places as what we thought. And it would flow. Not great. You have great porosity there. So lots of pore space in the rock, lots of oil in place. Will it move? And did move great. A vertical well problem is not economic because that's been tried. And a horizontal well was not economic. You get your inflow by putting meters in the ground, meters in zone. Because of the high porosity, it actually drills quite easy. Yep. So we'll drill maybe a well 900 meters deep and put 12, 15,000 meters of horizontal well in it. And then you get enough inflow to get some great wells.
I see.
Yeah.
And so how'd you get your first Clearwater assets?
So we bought in the Nipissing area, a couple of companies there. Interestingly, we bought a non-op position. Okay. It was our first place in. After we got that, the guy who was operating at the time went to buy the non-op position. They failed. We got it. And then we offered the operator cash, and then we got operatorship. Okay. So our first foray was like very low production, but a huge land base. And that turned out so well. Like it's got about 20 million barrels of oil in place per section. And we're going to recover under primary around 4.5%. So lots of inventory generated right off the hop and very successful.
So who is that company?
I don't know. Can I say, here, well, the operated company was Woodcote. I think we purchased 3 companies from those guys here so far or something like that. We then went down to the Jarvie area and we assembled some assets down there from to private companies. And then that gave us the bulk and wherewithal to take on an acquisition of Delta Stream in the Martin Hills area, private.
Right.
And that is the creme de la creme of the Clearwater, is in that Martin Hills area where Headwater and Spur and ourselves are.
Right. There's also Charlie Lake, which maybe we'll talk about. But so coming out of 2020 and then 2021, what do you think would have happened to the company if you hadn't found the Clearwater? What was your thoughts? Do you ever think about that?
Yeah, I just think it would have been, I don't know that we would have continued really, because you're going to, those assets were starting to run out of inventory. And, you'd had to make some pretty bold investments to gather, go farther with infrastructure. And when you look on a full cycle basis, it was very difficult to make that work. Yeah.
But you got into the Clearwater and then the Charlie Lake, which is also one of your main areas?
Yeah, Charlie Lake is a key area too. And as I say, when we put in the model, I think it was clear. If you look like at most analysts, even now, they'll have the Clearwater right at the top play in North America in terms of, how many payouts you get and things like that. And about the third or fourth play down is Charlie Lake. And Charlie Lake is similar in that I would call it a conventional play. Yeah, we do put some fracs in it, but it's not super tight and it's a carbonate. So you get porosity kind of come and go. You don't have to help it along very much to get a decent well. So those two plays, as we said, these two are the ones we want to be in.
How do you find out about the Charlie Lake formation?
So Charlie Lake formation, it became before COVID. I think it was before COVID. We looked at this particular company, a private. We couldn't get to valuation, but we could after. Eventually we worked it, and they came around, and we ended up doing a deal with them. And when we did our strategy, we were looking at, okay, let's look at the long term. Let's put the plays in the model that give us the maximum debt-adjusted free cash flow per share. And when we look back at the metrics that aided that, profit to investment ratio, or the number of paybacks, was probably more important over the longer term than a rate of return or a payout. So when I look at a conventional play, we had good payouts with Viking, but there wasn't much left after you got your first payout. And if you actually look at when you get your second payback, that's probably a better indicator of the quality of play than the first. And when you look at the second payback, some of these unconventional plays never get there. The best Permian gets maybe 2 to 2.5 times payback. I would say with our Clearwater wells, we're getting probably 5, and maybe in the tougher areas in the Clearwater, maybe 4. We're getting waterflood that's more like 9 times payback.
Right.
And you have a bit of delay in cash flow with the waterflood, but that is, from a PIR point of view, that's the best project that we have.
Sometimes when you get into a very profitable play, it's hard to pick it up for the right price because the seller knows that. How were you able to get into these areas for a price that provided value going forward? How did you think about that? Well,
there's two things. I mean, when we first got into Clearwater, there just wasn't many buyers because there wasn't much money around. Remember, you couldn't raise money anymore. You could issue some shares, to some extent, take on debt, and then you had to have enough good cash flow to kind of find your way out. But coming out of COVID, the assets weren't that expensive. Second thing I would say, the quality of the Clearwater was unknown from a primary point of view. Right. It was early days. And the third thing I would say is that nobody understood how successful this would be under waterflood. Mm-hmm. So it's kind of a real technical success there for the producers that are in that play right now.
So the seller didn't know that, but you also didn't necessarily know.
No, listen, I knew we had one good competitor there that we took a look at, and we knew that the primary wells were gangbusters.
I see.
And the risk you had is that in the large land deals, were you going to get the viscosity of oil that you thought? You kind of knew the thickness pretty much. You knew the porosity. Yeah, you even had a pretty good handle on the permeability, but you didn't know the oil quality and would it flow. And so, but as we started drilling it turned out really well. And we turned out some really good wells in the Nipissing area to get started.
So did you kind of think to yourself that we need to leave a margin of safety on our buying price just to make sure in case this asset doesn't work out?
Oh, for sure.
How
Yeah.
do you think about
Yeah. You basically, the seller wasn't looking for, they understood that risk too. So they weren't looking for, you didn't have a lot of competition on the assets because of the financial picture of most companies. Number one. Number two, no one was going to pay for, at the time, no one was paying for a lot of upside there in terms of what could be. So it turned out, once you got drilling in it, and then, wow, this is amazing. Yeah. I think that particular area was considered to be too wet. But there was too much water, but that wasn't the case.
Then you got into 2022. At that point, you knew the Clearwater was good, but so did Delta Stream. You did that deal. You did Crestwood before that. You did Rolling Hills. So you kind of rolled up a few companies. But at the time in 2022, it was a great year for the company. How did you get into, and how did you purchase those companies at a reasonable price when they knew the assets were good at that time?
Yeah, so you still had, I think those, if I talk in the Southern Clearwater area, the two privates that were there, they were ready to sell, and they were, the strategic model of those two privates was to get it to a certain point and then, but not ride it through. So they became pretty good opportunities for us. We had a little more competition on those companies, but not that many. And the oil price was starting to pick up, and we were starting to get some really good results out of the drilling program. So we became more confident quite quickly, and it became, we need to gather these assets while we can. Because they will get more expensive as balance sheets get stronger and other competition gets stronger.
So you knew that.
Yeah, it was because, I think, like I said, a lot of companies coming out of COVID manage themselves differently. And there's very good businesses there right now, good businesses that can compete with anything, any other sector right now. And so it was a matter of time that we were going to get more competition for sure.
And then oil hit $100 in 2022.
Yeah.
So how did that affect the company when you were looking to do deals?
You put your plan together, and we have a very disciplined process on acquisitions. I have to go to the board and show that whatever I buy, my 8-year debt-adjusted free cash flow per share goes up. That's really worked well. Like measuring that, being accountable to it, and incenting people on that metric. It really is your earnings, right? Is the way to think about that. And that's been very healthy for the company. We don't change the oil price. It was run at $55 back in 2022, and we don't change that. That you have to, and it really means that if you're going to deliver an asset into the company and bring it in, it has to have as good as or better quality than what you already have. And so that's really helped focus the company into these two plays.
And like we said, 2022, when you bought Delta Stream, lots of people knew there was oil in that area. Delta Stream knew there was lots of oil in that company, but so did some other people. So how did you win that process? I don't know if it's proprietary, but how did you come out on top in that?
Yeah. So,
deal?
well, I guess the deal is you pay more. I was, paid more than others, but there was a lot of competition on that asset that
Exactly.
it certainly would have been a quality asset to bring in, but the finance, and I give my CFO credit at the time, the financial engineering to bring that in became very difficult for others, and we found a way. So, because debt and issue some equity was it, and you're going to go in the hole for a while. It's going to hurt. So we were 1.4 billion in debt when we took that over, and were you willing to, were the assets going to perform to get yourself out of that debt? And you know what, we were very confident on the assets. I mean, there's wells there that are 60, there's 60 million barrels of oil per section in there. It's the thickest part, 25 meters thick. Most of the stuff that we're doing elsewhere is 8 to 20, somewhere in there. So there was no question that the quality of property there was there. It was doing great.
And so, yeah, the critic at the time would have said you took on too much debt. What would your response to that would have been? There's lots of oil here.
My response was that I felt that by developing it and focusing on debt, we could move that substantially. And, we got that down, we're around 700 now. So I think you had to, from the outsider looking in, you would have said that's a lot of debt for sure. But I felt that we had a good handle on the quality of play and that we could manage that and prosper quite well. And I would tell you today that asset is performing well above, so much farther above expectation than we had at the time, as good as we felt about it.
And one of the ways you got more oil out was the horizontal drilling technique, which is getting better all the time. But was the waterflood in your plans at the time?
Oh yeah, it was, because we had an operating waterflood in Nipissing.
Okay.
And we were getting phenomenal response already. And it is in terms of the asset, I've never managed an asset of that quality before.
Right.
Maybe there was one at Shell. Virginia Boy, I remember that was a great property too. Those wells are great, but nothing with the scale of this. And if you look at the top plays in North America, almost all the top North American plays are, in terms of return, are conventional. We just ran out of runway and that's why we went to unconventional. But to find a Clearwater with that runway that's there, I mean, it's massive. You can see the industry just ramping that it's amazing.
So it worked out well. It's continued to work out well. You also started paying a dividend in 2022, I think. How come you decided to start paying out some money to the shareholders?
Yeah, well, here's the deal: is that getting equity in is really important, and there's a certain amount of equity, especially retail guys, that want a dividend, and so we thought, okay, let's put a dividend in. Let's put it small, because I think the worst thing you could do is put a dividend in and pull it back.
Yeah.
So we've got a reasonable amount for a dividend. And then started with that. What's become evident on the model now is that buying back, knowing what we know today about the asset, buying the share back that's very lucrative for shareholders. Because what's happening is the free cash flow is outpacing the ability of the stock price to catch up. So and we can see that. And I'm not sure that the public has grasped that yet.
The industry evolved, I guess maybe you could say, out of COVID, where investors started to demand capital back in the form of dividends and buybacks and whatnot, but you were sitting on a great asset and you're still sitting on a great asset. So has it been difficult for you to make the decision between paying back some of your money to shareholders versus drilling such a great asset that you have?
Yeah, you know what? And I get capital allocation. If you're not good at capital allocation as a CEO, you might as well get out of the business, because it's just not going to work. And I will tell you that the shareholders' opinion of how they view share buybacks or growth, or like if I look at the levers, it's, do I pay down more debt? Do I pay that dividend? Do I increase that, or wouldn't take it away now?
Yep.
But do you buy back shares? Do you grow production with primary? Do you grow it with waterflood? And do you do exploration?
Yeah. So
those are kind of the 6 buckets. I've got about 2,100 wells there to drill, so I don't have to chase a bunch of exploration and do that. So we allocate some to lands on there, but not a lot. And I think right now, with the waterflood performing so well, I get my most paybacks are quite high, and oil price being low, we're investing in waterflood quite heavily right now. So, or fairly heavy, I would say. We're going to be taking injection from about 12,000 barrels a day at the start to about 32,000 by year end. And it's all about injection. If you want to find out how much waterflood, how much oil is coming at you next year, take a look at the injection this year. It's a pretty good leading indicator, right, of how that's going to work. But buying back, the way we look at buying back our shares is that it's quick. You get your production per share right now, and you buy all that upside with waterflood. I'm buying 2,900 wells. Like, that's the best acquisition I can do right now is my own paper, is bringing that in. So that's just one of 6 levers we got to maximize the yield that we're getting and return on capital invested. And that's running around 21-22%, which is quite outstanding.
Right.
Yeah.
And so another concern is that if and when oil prices do rise one day, you've got some great inventory. Do you think about preserving your widgets in the warehouse, so to speak, for that day when oil does go up again?
Well, if you have 20 years of inventory, it's not my concern to push that off anymore. I've got to find proper ways of bringing that back or buying shares to get more of that and watch your low price environment. So I think in this kind of environment, buying back your shares in a low commodity price environment and doing waterflood makes sense for the long term, your debt adjusted free cash flow per share.
This time.
At this time.
In the fall of 2025.
Yeah.
But if oil was to peak for whatever
reason. If oil goes, yeah, you could, you'd see us drill more of that. You'd still be able to buy back your shares and keep, because you got lots of free cash flow with high oil price, but you'd ramp up the primary production. Yeah.
A lot of good options.
It's like I said, it's amazing. When we were in debt, we had, and trying to pay off debt, we had one lever to pull. You gotta get that debt down.
Paying your mortgage down.
Yeah. But now we're in a very comfortable position. And we're going to hit that debt floor in 2027 of $500 million.
Mm-hmm.
These asset sales help us move that direction. So it's pretty exciting.
And so you've got a lot of good options, but when you look around within your area, do you see more acreage that you have your eye on without giving me your secrets? So do you have plenty of what you got now, or how are you thinking about that?
Yeah, we always pick up a little bit here and there. I don't get too much in the frothy stuff. But it's a fairly immature play, and there's a lot of different layers that you have to exploit, both in the Clearwater, and then you got Grand Rapids, and you got Wabasca, and so there's other zones too that are very exciting.
So you got other ideas in the back of your head.
Exactly, yeah.
And the takeaway or getting the oil to market in your area isn't a big problem, if I'm correct. How does that work when you're trying to get to market with the oil?
So there's 2 major pipelines in the area, Plains and Peace. They have capacity now, but the way the growth is going, it's going to get tight.
Yeah.
So we're trying to figure that out now, and how to make sure we have space here going forward. And it kind of depends on how everyone's plans are too. One of the advantages of buying back your shares and not growth is you don't run into those limitations. You're growing production without needing that space. Yeah. Production per share.
Another way you've grown is you've done some creative deals, taking on some royalty financing through companies like Topaz, which have been a great partner for Tamarck, if I'm correct. When did you start to realize that may be a good idea to do some
right from day one? That actually made a lot of sense. We knew the play would tolerate that, and we had to finance it somewhere. And so that, we partnered with Topaz, and they've been very helpful in helping us finance these acquisitions through that royalty program. They're good partners. That's worked out really well.
Even on the acreage, when you go back into legacy acreage, sometimes the concern is that it can't handle the royalty structures, but in this case it could.
You figure that out beforehand.
Encumbrances.
And you put it, that's the value proposition when you put it. And in some cases, you're just not going to get the property if you don't do that kind of deal.
Right.
And so Topaz has been a really good partner in that aspect.
Another benefit of doing the waterflood is the royalty breaks that I think the company's been getting. I don't know if you can talk about it, but...
Well, there's no royalty breaks for waterflood.
Okay.
Unfortunately. There is for drilling, but there's no royalty breaks for waterflood. So, but the performance of the waterflood is so good. Like, if I just refer to one well in Martin Hills, let me just tell you a little bit here this year. Right now we have 26 wells that are affected by waterflood, and they've gone up 40% year to date. So no capital, just responding to injection that you put in last year. So that's going to drive our declines. Our declines in the Clearwater, I think at the end of 5 years, will be somewhere around 17% from about 28% now. So, and I would say we're based on the results we're seeing, that they'll probably drop even further from what I'm seeing today. We have one well in Martin Hills. Tell the story about it. 15-2. Yeah, I think it's the largest cumulative producer in the Clearwater. It's produced about 500,000 barrels under primary, paid out 15 times. And it was doing about 100 barrels a day. And when we start putting water in and cranking up the water rates, that well is doing around 800-900 barrels a day right now. So beats its primary. It's just picked right up, and it's an outstanding well.
Wow.
Yeah.
And hard to beat.
It's just hard to beat. So everybody's, you're cherry picking your wells, but there's lots of wells like that. There really is, and it doesn't seem to be, we use different configurations for different patterns. We use bottom up water or sideways. It's called the W pattern, but all those patterns are working very well.
And while you are drilling, the horizontal well technology is getting better every day. Are there any new technologies that you're leaning into on the wells?
We were out at the rig a couple of days ago, and those wells, like we have, we're on a lease that we're leaving right now. It's got, we just finished 12 wells there. We're going to one with 17. We got one pad we're constructing ultimately with all the different layers. It's going to have over 40 wells on it. We use walking rigs, so to go from one well to the next, if it's in line, it takes an hour.
Right.
It's not
long.
not a day. Move the trucks and everything like that. It moves on rails, and it's just and so we're getting good at it. We drilled about 1,400 kilometers of well bore last year in the company. That's enough to get from Calgary to past Winnipeg, one company, and that's how many meters you got. So if you knock a few meters, we knocked about $7 a meter off our cost structure last year, and that works out to, I think we saved about $10 million last year in total with that.
Do you ever think of the resource plays? Or do you have enough on your plate right now without looking north to, say, the D Basin or Montney?
It just can't compete for capital. It can't.
Okay.
And so with all the inventory I've got and Waterflood there, it wouldn't compete for capital.
You got enough to drill now?
I got enough.
Which is a good problem to have. All right. A couple questions from Max, if that works for you.
You bet.
First one, this comes from a fellow named John, and the question was on buybacks and if the current level of buybacks is going to stay the same at the current level going forward.
Yeah, so it depends a bit on what happens in the market. But I would, like I said earlier, with the free cash flow as a percentage of enterprise value increasing faster than the share price, it tells you that the value creation on your buybacks is getting even better. So we would continue the buyback program as we've got in our capital structure in our presentation. So when we're allocating now 60% goes to shareholder return and another 40% to debt. Once we hit the 500, it's going to be about 80% will go to shareholders.
Okay. This one comes from Energy Investor. He had a bunch of questions, so maybe we'll go through if it works. The first one was on the Waterfloods, which, like we said, have been going really well. How does the company target which locations to use the waterflood on? Is it new wells versus older wells? And how are you thinking about that now?
Yeah, it's a good question because in Martin Hills, there's been some depletion that's happened, and we actually thought we'd have to put a lot of water in to get response, but we're seeing that's not the case. Ideally, you want to do those injectors the same time that you do the producers. Nipissing, we proved that's a really good formula. So we've got a little bit of catch up to do to get our injectors in because we were focused on debt reduction first. And so we'll be playing catch up here in the next year. I would look for, 26 to be as a percentage of our capital. More will be going to Waterflood next year again to play that catch up. But the response on the depleted, what we call depleted zones, you have so much oil in place that we're finding it's not as depleted, and the response has been quite good.
The next one is, do you feel like there has been a larger than normal disconnect with what you're internally seeing on your assets versus the reserve report compared to other players in the basin? How do you feel the evaluations can catch up to some of those other plays?
You know, I'm glad you brought that up, because probably that's the biggest question we get is your PDP reserves. How come? Well, the first thing I would say is that conventional and unconventional plays get booked differently. With a few wells, you can book a township if in the unconventional, as long as you show that you got zone all over the place. And that was put in place because it takes major facilities to collect that, and you need a number of wells to do that. The booking for a horizontal well is you get approved and you get a putt on each side and then a prob ball on the other side. So you can't even book in many cases a full section. So they're booked differently. Second thing I would tell you is the water flood. You're not going to get credit until they see what happens. And these water floods are relatively early, even though it's been, 3 years injection. So, we're saying that these are going to get about 2.5 times. If you take your primary, you're going to get ultimate 2.5 times there, but you're not going to get anywhere near the booking on that. So what does that mean? It means you're going to get large technical revisions. And if you look at us relative to other companies, we were the highest company in technical revisions at 17%. So as the reserve valuers give you credit and you bring in more results where the production keeps going up, take that well that I talked to you, the 15-2 well, they responded, came back from 125 to 200. They booked it, went to 400. They booked it. Now it's 800. So they're going to book it again. And it probably, they've tripled the reserves. They will have tripled the reserves on that. From what they initially thought. So this year, with the performance we're seeing, that the 40% on the 26 wells, I'm expecting that things will be quite favorable for us on that.
Give the cost control measures successfully implemented over the last 2 years. Do you see some good cost control opportunities in the next 2 years? And if so, what are you most excited about?
Yeah, so we've seen our operating costs drop, largely because of the well outperformance, but also because of the guys are managing their cost structure in the field. The capital costs are affected by the number of layers that we get in there and getting more wells per pad and figuring out how to drill faster at greater speeds. So I think as long as I don't have to branch out into greenfield areas, you'll see that our cost structure will be very competitive. I think relative to our competition, we should be the best on that.
And with production continuing to surprise on the upside, is there an opportunity to upward revise the net debt targets given the low cost of the debt compared to equity? Or perhaps add an incremental target between current net debt and the $500 million ultimate?
I found that for the most part, if you stay with a plan, then you become predictable, and that results in a better share price at the end of the day because you're not giving shareholders surprises. So I think as a rule, we'll stay fairly close to the capital, the return structure that we have in our presentation. But I also think that we are going to take the flexibility and be opportunistic if share price, were to fall. Maybe you get a bit more aggressive, where we see some better positive things yet again, and we need to take advantage of that. So, and then we've got the proceeds from the disposition that we brought in that kind of accelerated that anyway. So I think the board will have some interesting discussions about how to give yourself some flexibility and be a bit more dynamic.
There's more questions. I don't know if you want to keep going.
No,
a few more.
Yeah.
This is direct from people on X. So maybe we'll just do a few more. That
Sure.
works.
Yeah.
Given the relatively small size of the Clearwater area, do you feel like there will ultimately be consolidation with in the area playing a role in the next few years? And how are you thinking about that?
Yeah, I think there'll be consolidation ultimately, but I don't think it's on anyone's mind really right now. We're trading a fair bit below the other two major Clearwater players in terms of multiples. That I think has started to close, but still not to the extent that we'd like to see that. So I think what we'd like to see that is get things a little bit closer, and I think for the management team, we're all going to do the right thing at the right time and represent our shareholders well. But we're just pretty happy with what we got here and demonstrating it. And I think as time goes by, we're feeling better and better about the future.
Now that you've had the Delta Stream assets for about 3 years, what has surprised you the most about them?
Oh, that I remember the guys telling me, Brian, you can't take a well over its primary peak production, and to see that blow it by almost double it, like it's just phenomenal. So I think, hey, that's been a surprise to me. I'm an optimist on the waterflood anyway, but to see that response and that quick, and technically there's some very good reasons why that waterflood is working, and it has to do if you look at the travel of water toward a producer, it's very slow. Right. And I think that's the thing that's misunderstood. People are thinking vertical wells like we used to do in the basin. When you do a horizontal, that water flood front is centimeters per month, not meters. And yet the pressure wave moved very quickly to give you a good response. And so we understand that a lot better now. And so we feel even more compelled on the water flood. I'm excited about it.
You just got rid of the Viking and Cardium assets that you had. I think the deal was announced yesterday. Mm-hmm. But do you worry that the company that bought them may see something you don't? You sold them to a company that knows what they're doing. Do you ever consider that, or do you have enough opportunity where you are now in the Clearwater?
I think, yeah, we have enough opportunity right now. So if you look at the use of proceeds from that, we can do very well with the use of proceeds on that. Even if I took some of that money and put it into Waterflood, it's just going to be phenomenal. Yeah.
Well, I think that's a great summary of the company. Do you want to do some current events, or should we head towards the end? I don't know what your time is like.
Yeah, today, so just a couple of things. One thing that I think we didn't cover that I should is we do quite a bit of work with Indigenous and work in that. I'm a chieftain of the Ghana tribe in southern Alberta. Mm-hmm. And I think we did a very unique deal with the Alberta government, AIOC, to sell our facilities on there. And as you know, Indigenous relations is really important on Crown acreage and how you manage that relationship. So I'm pleased to, if anyone has any questions, certainly about that, that's been a real advantage for us.
And it is the fall of 2025. The messaging coming from the federal government is getting better, and with support of the industry, do you see that building and helping Tamarck going forward? How are you thinking about that?
Yeah, I think I was asked a few times over the last month, and we just signed a letter from, I think there was 95 signatures on the letter that went to Prime Minister Carney about what we need to have. And listen, I'm from what I see so far, I'm pleased. And I spoke before the sometimes no more bad stuff happening is good. Yeah. And I'm not seeing any more bad stuff happening. It just seemed like for a while there, every 2 months, there was something else coming out we had to react to and was not positive. And so I think that the messaging that we're getting, the signals we're getting from the Prime Minister are quite positive. He's got his project list. He's going to streamline some of the regulations to get there. I would say things are not happening fast enough in terms of action, but the words are there. And I think he's put in some good people to lead this along. The establishment of the office in Calgary, the major projects office, I think is a very wise move. I think in industry, we've asked to solve some other problems so that we let private industry, private money fund some of these projects here going forward. And what about all the projects that don't fit on the list, but are there sitting on back burners because of different kinds of regulations, emissions cap, the C-59, the greenwashing, anti-greenwashing. There's just a number of things that have to be removed for us to proceed.
The reason there's been a push to get the industry going again is because the perception is that investors aren't interested in Canada, and as a result, the stock prices are low. It's hard to get capital, and it just trickles down. But as a small to intermediate energy company operating now, do you think that affects you in the markets? How much does it touch you when you're not a major? Does it make a big difference for companies?
Oh, yeah. Because I would say, when I look at the equity, probably I was about 40% owned by Montreal, Pensions Montreal. They're pretty much gone now. Maybe I'm 10% somewhere in there now, but the Americans have stepped in, so they're looking at the lack of infrastructure now is that the differentials have shrunk up, and And you know what? We got some breathing room here for 2 to 3 years till we fill up again. And they're not panicking too much about stepping in there. So I am getting good American interest. I guess the question is, what happened to the Canadian pensions? Why did they pull out of our industry being Canadian? And I think that's been a bit of a disappointment, is that you don't even get a meeting anymore. But yet I met with a teacher's pension in the United States from a very leftist state, and yet they get around very large, larger than some of the ones we have, most of the ones we have, and yet they're willing to step in on the fossil fuel thing. So I think getting equity, I think we should start in Canada and find out why we're not investing in our own businesses here. That's a really important question.
The other worry, I guess, part of that is the returns have been so great in other sectors. You compare good business and energy, you have to compare it against maybe the Mag 7 or any business that trickles down from that. Do you think it's been a draw of capital?
Oh, I think so. Yeah, I think it's not necessarily of U.S. versus Canada multiples. Yeah, there's a little difference in multiples for sure. We have some more complications. So yeah, but most of the lack of equity in the sector has been, the tech sectors have been so strong. And so I don't, if I feel I can manage just perfectly the way we are. And from a yield point of view and shareholder point of view, I think, I can give a lot of, I think in 5 years, we can pretty much buy back all our stock. We got a little help in all prices. So, and it's a healthy business with lots. So I'm happy the way things are right now. I worry about when pipes get full and differentials grow, and I just don't want to get into this rail stuff and panicking to get volumes. Like, at one time we were $55 WTI worst case and $45 diff. Like, it wasn't, that's probably been the worst. And I just don't want to go back there. So I hope that whatever Prime Minister Carney does, we find an oil egress solution that's acceptable.
The reason that pipeline wasn't on the initial list of projects is because from their perspective, we don't need another line, and there's plenty of capacity in the lines. What has your experience been with that?
Well, if you look at the oil sands guys have been cranking up a bit of volume optimizing, and that's going to happen. And even the Clearwater, we're going to put a bunch more production on over the next while. So we're going to run out of space. I think it's not that we don't need a pipeline. It's that is a more difficult issue to tackle and do you want to start out of the gate with that?
I see.
So we do need to find a solution on the oil egress side, for not to mention our own sovereignty. But the West Coast is an obvious solution.
So there's a need for more pipelines because producers can fill them up. If they're not maybe full right now, they could be, and they will be.
That's they will be. Yeah, they will be full. So, and given it takes a long time to get this off the ground, you got to get going. And Trans Mountain can be debottlenecked, and there's some advantages there that will help push that off a little bit. But we got to get working on something more material.
From your perspective, is there a pipeline that you would like to see get upgraded or start to be expanded? Which one are you looking?
Well, I think the easy hits are Trans Mountain and
going west
and debottlenecking that there's some opportunity there. I mean, the sad part is Gateway didn't go. I know people